I was just out taking some deadwood off the apple tree here. Um, it's starting to bud now, and you can see we had some winter kill. But it got me thinking. This tree came from the church when we built the new, larger facility. Um, this was planted probably in the 40s, maybe, and it it needed to be transplanted because it would be destroyed by the new construction. So I paid to have it moved over to my house, and it's kind of neat. We never know who planted it or what, but it was probably some guy on the grounds committee trying to give the pastor a couple apple trees. It was a small little orchard there, and now it feeds our neighbors, feeds me and the family. So, but it got me thinking about how forward-looking we need to be um, in our church, and always looking ahead. And where this tree required a little bit of effort to grow and prune over the years, every year it provides the fruit, right? And some worms, but that's church life, isn't it? And right now, the churches are really struggling with the government response to the contagion. Some churches are not allowed to meet because of the concern over large gatherings, even though it's not scientific. And the churches are really discovering the need for finance because the banks obviously don't want to loan to churches to help make payroll. And there's a solution for that. And it involves something our grandparents used. They got the country through the first Great Depression. And let me run in the house here and show you what I mean. Continuing my thoughts from outside, yeah, every church, we have a roof that needs to be replaced every 20 years, right? We have furnace that'll go out in the winter at the wrong time. Maybe we want to add air conditioning to our older building. We're always looking for, updating the interior, expanding our ministries, adding childcare, a special center for that. That's increasingly common. Maybe even adding a daughter congregation in the town over or down the road. And of course, we all look forward to a new building with updated interiors and more space. And we should be setting aside capital safely for these known future expenses. We should do that every week. But it requires discipline, and there's so much uncertainty with all this because the way Wall Street and the big banks want us to do it, put it in the savings account and then spend it, and then it's gone forever. So we're always on the treadmill of, fundraising and, replacing what was lost, what was down the road. And frankly, there are better ways to do it because we need capital just like any other organization. And as we're discovering in the last few months here, when economic hardship strikes, when we're in a recession, the banks are reluctant to lend and everything kind of goes on hold. And frankly, the best way to keep control of your capital is what your grandparents used. In 1900, half of the nation's savings was in cash value life insurance. And nowadays we look for, dividend paying, high cash value, whole life insurance, very ordinary stuff issued from mutual life insurance companies. Ideally, you want to work with a authorized practitioner who's been trained by the Nelson Nash Institute. We use the economic and insurance principles outlined in the book Becoming Your Own Banker, written by Nelson Nash. We refer to it as the infinite banking concept. So if you research it, always look for those key words, the infinite banking concept, and look for authorized practitioners because we're not going to lead you astray with all the other nonsense in the insurance industry. The secret sauce of what makes the infinite banking concept work is that the capital of the insurance policy is continuously compounding. It's always growing. month after month. Like I said before, when we save it up in a savings account, for, new carpeting or whatnot, we spend it and it's gone. And we're always starting with zero. The insurance policies, there's no market volatility. There's no stock market surprises. The commitments that we make are very known ahead of time with insurance, very predictable, which is what church boards want month after month, right? Our contracts with insurance companies are unilateral. We are in control of what we do with the contract. We're able to reuse the capital that we have with the contracts. Tie up that cash value with a policy loan. As we repay it, we're able to reuse it, and that makes it unique among any other product. And this is life insurance. The idea here is that there are true costs to the church. If we do lose a pastor or a school principal, a key employee to the church, we have a cost to replace them, and that's the value of life insurance. And all along the way, we have reuse of the cash value, and we'll get into more of that later. Of course, we can't talk about church finance without the nonsense from Dave Ramsey. I've taught the Dave Ramsey class at church for several sessions. He's great for marriage counseling and, straightforward budgeting. He's terrible theology-wise, and economically and investing wise, it's just dreadful. His program is, in terms of, paying cash all the time, you're always back to zero. You're never advancing. So for the capital needs of the congregation, we may save up and pay cash, but we're always back to zero. We're always on the fundraising treadmill. The core problem is that paying cash ignores the opportunity cost. It's wrong to say that just because we're not making an interest payment, right? Just because we're not, if we avoid debt, true, we're not paying interest, but there is an interest expense because we're giving up what that money would have otherwise earned. When we're, back down to zero, we're not earning any interest. We're not getting any return on our capital. The big challenge we have with, our church boards, and I've been there, is these surprises that come up. The nice thing about the infinite banking concept is as you repay your church loans, your capital is immediately available. So, if you make a $500 payment on what you'd already borrowed from your policy or through your policy, that money is available immediately if something else were to come up. And the capital is continuously growing, whether you borrow against it or not. And that's a direct contrast to, the bonds and stocks and CDs. Once that money is spent, it's gone forever. So when we have little projects that come up like, recarpeting an area that was flooded, or you just want to upgrade and update, moving expenses for a new pastor, maybe you want to increase your property and casualty insurance deductibles and save money that way and kind of self-insure that portion, refinishing the gym floor. We had a parsonage furnace go out in middle of winter. We always have concerns with asbestos remediation. Every 20 years, you got to put a new roof on. You got to be saving for that. Maybe you want to add another pastor or two or three, and that takes some time for the congregation to grow into that. Well, you need to subsidize that somehow, and that requires capital. Maybe there's a major issue weather-wise, and your region needs disaster relief. You can have money in your checking account within, a few days to provide relief. Maybe you want to spin off a daughter congregation, add to school. So you can see as more capital becomes available, you have more choices. Here's the mechanism for that. It's, this is an example illustration. In the insurance world, we call these illustrations. They're projections of what a policy would look like in the future. And in this case, we're just, using a called worker, whether it's a principal, teacher, or a pastor. And in this case, I had to start somewhere, so just said a male, age 40, standard health, nothing particular. The issue is we want to stick with the basics. We're going with a mutual insurance company, in this case Lafayette Life. And mutual means that the policy owners own the company. We want the policy properly structured for high cash value, and that's where it's, again, important to work with an authorized practitioner from the Nelson Nash Institute. In this case, it's a single premium whole life with some additional riders, which allows us to put more money into the policy. and the dividends will be purchasing additional paid-up insurance. And there's some rationale for that. And this is properly structured for something the church would own. If this was an individual that was going to own it for their own purposes, I would do it differently for tax consequences, but that's another issue. So again, go to infinitebanking.org and find a local expert. Mutual life insurance companies can pay dividends to your policy, and what that reflects is the profitability of the insurance company. You've paid in some premium, and depending on the profitability of the insurance company, they return some of that premium to you. The nice thing about insurance is that there are guarantees. In this case, we have guaranteed contributions that we as owners are responsible for, and that won't go up. Unlike some weird insurance policies that they can charge you a lot more, surprise, and that's not something churches are really should be pursuing. So stick with the simple stuff. We also have guaranteed cash values. Very predictable. Over here, as dividends, if they're declared, the cash values increase, but it's nice to know what we have looking forward to. That's guaranteed year over year. Like I say, the insurance company can declare dividends. They're not guaranteed. And we're using them to purchase additional death benefit. And that's that death benefit that pulls upward that cash value and accelerates it year over year as those dividends are declared. The church is always thinking ahead to future generations, and here we're just looking at the first 20 years or so. We have consistent premiums, guaranteed future cash values, and importantly, this is life insurance. Eventually we all meet our eternal reward, and here we have guaranteed death benefit, and with dividends reinvested, a higher death benefit. But even after 20 years, there's a death benefit of almost $250,000 off a very simple policy of $50 a week. If we go farther down the road, say 50 years into this policy, we can see there's very substantial death benefits. And here, if the pastor's 90 years old and retired and living in Boca Raton, Florida or whatnot, we get word that he passes, and church then receives, say in this case, $500,000 or so. And all along the way, we had an increasing pool of capital to, conduct the church's work. So my encouragement is to start simply, pretty straightforward whole life insurance policy, nothing with too much sizzle. Just use it, watch it grow, add to it as you're able. And as it grows, you're going to want to add a second policy, because once you understand how it works and how powerful it is, all of a sudden your youth pastor needs a policy, and your school principal needs a policy, and so forth. There's so much work to be done in the church. You'll just see as these grow, going to want to add to it. So I hope this is helpful. Shoot me a direct message if you have any questions. Of course, you can learn more at infinitebanking.org.